Day 44, continuing with the um, chapter 5 problem sets. Question number 7. Suppose your expectations regarding the stock price are as follows: state of the market, probability, ending price, HPR, including dividends. Use equations 5.11 and 5.12 to compute the mean and standard deviation of the HPR on the stocks. So mean expected return equals to summation of um, and 2.445. So basically the product of the probability and the HPR for each individual case, so sum is the expected return, which comes around 14%. Variance, return minus the okay. So in variance we are multiplying the probability into bracket open 0.445, which is the return for this one, minus 0.14, which is the expected return, which we just calculated, to the power 2 whole square. Same thing for the other ones, a normal growth and recession. To find out that the variance is 0.06551175, standard deviation then will become square root of variance, which comes to 25.52%. Answer 8. Probability distribution of 1 year HPR on a 30-year 8% coupon bond selling at par. Okay, question number 8 is derive the probability distribution of the 1 year HPR on 30-year US Treasury bond with an 8% coupon if it's already currently selling at par, and the probability distribution of its yield to maturity a year from now is as follows. For simplicity, assume the entire 8% coupon is paid at the end of the year rather than every 6 months. So probability distribution 1 year HPR on a 30-year 8% coupon bond selling at par. Current price equals to par equals to $1,000 since selling at par with 8% coupon. Year to maturity equals to 8%. Coupon payment at the year end equals to $80. Price in 1 year depends on the next year's YTM, yield to maturity. Price in 1 year formula, since it becomes a 29-year bond, price equals to coupon into. There's some calculation here. Honestly, I have no idea what's going on here, but anyways, let's skip to the next question probably. Determine the standard deviation of a random variable q with the following probability distribution. Value of q 0, 1, 2, probability that. So mean equals to 0 into 0.25 plus 1 into 0.25 plus 2 into 0.5, which is equal to 1.25. Variance equals to probability okay 0.25 into 0 minus 1.25 whole square plus 0.25 into 1 minus 1.25 whole square plus 0.5 into 2 minus 1.25 whole square, which comes down to 0.6875. Standard deviation equals to square root of variance, therefore standard deviation equals to square root of 0.6875, which is equal to 0.8292. Next question, 10th. The continuously compounded annual return on a stock is normally distributed with a mean of 20% and a standard deviation of 30%. With 95.44% confidence, we should expect its actual return in any particular year to be between which pair of values? Hint: look again at figure 5.4. Uh, um, The continuously compounded annual return on a stock is normally distributed with a mean of 20% and standard deviation of 30%. With 95.44% confidence, we should expect its actual return in any particular year to be between which pair of values? Hint: look again at figure 5.4. Given mean 20%, standard deviation 30%, confidence 95.44%. Which corresponds to plus minus 2 standard deviations for normal distribution. The actual return continuously compound will be between mean minus so mu minus 2 sigma and mu plus 2 sigma, since that is the range for a confidence interval of 95.44%. Therefore, the lower bound will be mu minus 2 sigma. Mu is 20%, sigma is 30%. So 20% minus 2 into 30% equals to minus 40%, and same for upper bound 80%. Therefore, minus 40% and 80%, which is option A. Then we have the 11th question. Using historical risk premiums from table 5.4 over the 1926 to 2016 period as your guide, what would be your estimate of the expected annual HPR on the big value portfolio if the current risk-free interest rate is 3%? Uh, Assume from table 5.4, 1926 2016, historical risk premium from big value, likely the large value portfolio, is approximately 5 to 6% over T-bills, using a midpoint of 5.5%, current risk-free rate 3%. The expected annual HPR equals to risk-free rate plus historical risk premium. 3 plus 5.5% equals to 8.5%. Question number 12. So let's skip this one. Yeah, okay. Question number 13. During a period of severe inflation, a bond offered a nominal HPR of 80% per year. The inflation rate was 70% per year. What was the real HPR on the bond over the year? Exact real HPR equals 1 plus nominal HPR divided by 1 plus inflation rate minus 1. So 1 plus 0.8 divided by 1 plus 0.7 minus 1. So 1.8 by 1.7 minus 1, which is equal to 5.88%. Part B. Compare this real HPR to the approximation R real equals to approximately R nominal minus I. Approximation, so 80 minus 70 equals to 10. The approximation overestimates the real return by about 4.12 percentage points. The approximation error becomes significant when inflation is high. Question number 14. Suppose that the inflation rate is expected to be 3% in the near future using the historical data provided in this chapter. What would your predictions be for the T-bill rate? The T-bill rate equals to around approximately equals to expected inflation plus historical average real T-bill rate. Historical T-bill rate equals to 0.5%. Predicted T-bill rate is 3% plus 0.5%, 3.5%. Okay. Part B is the expected rate of return on the big value portfolio. Expected return on the big value portfolio, approximately T-bill rate plus historical premium. Historical risk premium for big value 5.5% from earlier. Expected return 3.5% plus 5.5, 9%. The risk premium on the stock market, part C. The risk premium stock market approximately equal to historical equity risk premium is which is approximately equal to 5.5%, assuming it is stable. Question number 15. An economy is making a rapid recovery from steep recession, and businesses foresee a need for large amounts of capital investment. Why would this development affect real interest rates? Effective rapid recovery and capital investment on real interest rates. Increased capital investment raises the demand for loanable funds. In the loanable funds framework, this shifts the demand curve to the right, leading to an increase in the real interest rates. You are faced with the probability distribution of the HPR on the stock market index fund given in spreadsheet 5.1 of the text. Suppose the price of a put option on the share of the index fund with exercise price of $110 and a time to expiration of 1 year is $12. What is the probability distribution of the HPR on the put option? HPR on put option portfolio given data from spreadsheet 5.1. Assume from spreadsheet 5.1 already here the HPR is some more calculation, so let's leave that since there's really no point in reading that out loud. Anyways, question number 17 is take as there's a lot of calculations here too, so let's leave that as well. Okay. Okay. So the last question. Consider these long-term investment data. The price of a 10-year $100 par value zero coupon inflation index bond is $84.49. A real estate property is expected to yield 2% per quarter nominal with an SD of the effective quarterly rate of 10%. Compute the annual rate of return on the real, that is inflation indexed bond. Compute the continuously compounded annual risk premium on the real estate investment. Use the formula in footnote 17 and Excel's solver or goal seek to find the standard deviation of the continuously compounded annual excess return on the real estate investment. What is the probability of loss or shortfall after 10 years? So long-term investment analysis, part A, annual rate of return on the real inflation index bond. So the bond is a zero coupon inflation index bond with a 10-year maturity. Price equals to $84.49 and par value is $100. The annual rate of return R satisfies 84.49 times 1 plus R to the power 10 equals to 100. 1 plus R to the power 10 equals to 100 by 84.49, which is approximately equal to 1.1836. 1 plus R equals to 1.1836 to the power 1 by 10, which is approximately equals to 1.0170. So R is approximately equal to 1.70% per year real. Part B, continuously compound annual risk premium on the real estate investment. Real estate expected nominal quarterly yield is 2%. Simple. Quarterly continuously compounded return, natural log ln bracket 1 plus 0.02 is bracket close, approximately equal to 0.019803. So anyways, more calculation stuff which is kind of pointless right now, so I'll just skip all that. Anyways, moving on to the CFA problems. Right, CFA problems. Given $100,000 to invest, what is the expected risk premium in dollars of investing in equities versus risk-free T-bills, U.S. Treasury bills, based on the following table? Expected risk premium in dollars, expected return from equities $50,000, expected return from T-bills $5,000. Expected risk premium 50,000 minus 5,000, $45,000. Expected portfolio return. Okay. Expected portfolio return for the second question. 10% by adding the products, these three. You have minus 5% plus 3% plus 5%, which equal to 10%. Anyways, man, yeah, I'm done. This chapter is over. Anyways, okay, I'm done. Anyways, yeah, thanks.